All right, in this lesson we are going to talk about management assertions. Okay, now this is probably one of those things that a lot of students miss, they gloss over, and then when they're trying to do test work, they're going, what am I really testing, or why are we testing this? So I think in this section, management assertion is probably one of the most important things that you need to get out and you need to understand from an auditing perspective, and then it'll start to make sense later on what you're doing. So as much as I think every one of my lectures are important, this one and the next one are probably more important because it gives you a good foundation of what you're doing. I mean, a lot of times people ask, what am I really doing? Well, this is what you're doing. You are looking at this stuff here. You're not necessarily looking at the end number at the end of the day. So that's why I think this is important. As we start to get to these two lessons, then you'll probably understand a little bit more the importance of this. And then we'll always go back to these assertions later on. So what are management assertions? Management assertions are, well, what assertions are statements of facts or beliefs. Now, we only care about management's assertions, so they're statements of facts and belief as they have an impact on the actual financial statement that is sent to shareholders and external users of them. So that's our most important. Management can make assertions about things that have nothing to do about the economic climate of their organization, and if they do, we don't care about those assertions. We only care about the assertions that are important to the financial statement and the presentation of those financial statements. Okay, so assertions are statements of facts or belief, and we care about management's assertions of statements of facts or belief. Now, there's two types of assertions. There's explicit assertions and implicit assertions. Explicit assertions are things that have to be told to you. It's explicitly stated to you. So, for instance, examples would be handicap spaces. Well, how do you know that a space is designated for a handicap? It's got to be told to you. It's got to have the blue lines. It's got to have a blue sign or whatever the state requirements on for it, but it has to be told to you. If it's not told to you, you just assume it's a space available for anyone. That's explicit. Okay, it's got to be told to you. Restroom gender. How do you know? You've got two doors going to the restroom. How do you know one's for male? How do you know one's for female? Okay, unless you're at a Starbucks, which that's a whole different story. But if you are at a ballpark and there's one designated for a female and one designated for males, how do you know which ones to go into? It's got to be explicitly told to you, so they've got to put signs up so that you're not walking into the wrong restroom, okay? And that would be an awkward situation there. What about nuts analogies? So now we've got this nut analogy phase where that's becoming more prevalent here. And so more and more restaurants are up front with you and telling you that their food is contaminated by nuts, and if you have any allergies, that you need to tell them so that they can work with you. So again, that's maybe not at the forefront in some states or some locations that you're in, but that is becoming more prevalent. So again, these are things that have to be told to you. You can't just assume it based on the facts. Now, the other type of assertions are implicit assertions. Implicit assertions are things that are understood or assumed by you. So the example I'm going to use is at a restaurant. If you order something at a restaurant and they bring you out food, these are things that are implicitly you expect from, or it's understood that you know this, and they don't have to tell you up front. The first thing is food is cooked to temperature. So when they hand you the food, you assume that the food was cooked to temperature. The food is fresh and not expired. When you receive the food, it is implied that the food is not expired or not fresh. And I don't mean fresh by vegetables and things like that. I mean that it's fresh and not expired. Okay? Utensils and prep areas are clean, so you assume explicit assertion. It's asserted that they're preparing your meal in a clean environment with clean utensils and clean prep areas. And this is even more so today with a lot of cities and counties and states requiring letter grades on the outside of restaurants to tell you how clean or not clean their back areas are. So that becomes an implicit to now an explicit in some areas, okay? And then it is understood and it's implied that the food has not been used before. We've probably heard these stories where some restaurants, if you haven't touched the rolls, that they may use it as day-old bread later on and cut them up into croutons. I don't know if that happens, but if you are in the restaurant industry and that's happened to you, you know more about it than I do, but it is assumed that it hasn't been used before, okay? I believe the standard is once it hits the table, it can't be taken back, okay? Or out of the kitchen, I don't know, something like that. I'm not in the food industry. Okay, so those are implicit. These are things, they don't have to tell you this. It is implied that these things would happen, okay? So these are the two types of assertions. Now, accountants and their managers make assertions, okay? We make assertions when we are putting things on a financial statement. So for instance, example would be cash. If we said cash is 2.6 million, there are some things that are being implied by that number of 2.6 million on the financial statement. Some things that are being implied, implicit assertion, is that it actually exists. If you're looking at a financial statement that says $2.6 million in cash, it's implied that it actually exists. It's not a fake number that they just threw a number on the financial statement. So when they give you the financial statement, it's implied to you, asserted to you, that it actually exists. That it's complete, that all the cash is actually there. So when I look at 2.6 million, there isn't like $500,000 that are sitting in a safe somewhere. All the cash is reported on the financial statement. It's implied that it's complete. It's accurate, so we expect that this is accurate, okay? That there's no misnotion of the number there. That there's no claims to that. Now, if you haven't been in business before, you haven't really studied business, you'll know that here when we say no claims, there may be situations where the bank might say, hey, we will give you a loan if you put $500,000 of cash in our bank and it's restricted, meaning you can't use it. That's kind of their safeguard that they're going to get paid back later on. Well, this is assuming that it is not restricted in any way, so there's no claims to it, because if it was restricted, then it shouldn't be here. It should be on a separate line item on the financial statement. So these are things that are implied, okay? Now, why is that important? As auditors, we don't test necessarily the number, we test the assertions. If the assertions are correct, then we would assume that the number is correct. So that's a very different distinction. People think auditors, we go right after the number. We don't go after the number, we go after the assertions, okay? Does it actually exist? Well, we're going to need to figure that out. Okay, so as auditors, we test the assertions by management by gathering appropriate audit evidence. So for instance, in this situation of cash, one thing that we might do is a bank confirmation. We might send a letter to the bank saying, hey, we want you to confirm the amount of cash that was in their bank account on 12/31. So you send a letter to them, they send you, the auditor, the letter back. They don't send it to your client and your client comes and gives it to you. The bank needs to send it directly to your offices. That is not the offices of the client. Now, I know we haven't talked a lot about auditors, okay, and how they work in their work environment, but auditors work typically at their client site. So you could technically have mail sent to the client site. In bank confirmations, because we're worried that fraud might happen, those confirmations need to be sent back to the audit firm, and typically you would have a first year go pick it up from your firm and bring it to the client site so that there is less risk that it could have been tampered with, because if it gets sent back to the company could theoretically tamper it and then give it to you tampered, and we don't want that because that doesn't help us get to the point of does it exist. So that's what a bank confirmation. We're going to ask the bank to confirm the amount that we show on the book for the client as of 12/31 or the end of the year. Okay, so auditors try to substantiate management's assertions, and if they can, we can assume that the financial statements are presented fairly in all material respects to the results of the company. So we look at these assertions, we test these assertions. If the assertions are correct, then we can say that in all material respects, the financial statements are presented fairly in accordance with U.S. GAAP. Okay? So that's what we're trying to do there. We must substantiate all the assertions that the management makes. And if we can do that, and we can look at the financial statement as a whole, then we can say that the financial statements are good. Okay? So that's what we're doing. So in this section, this lesson here, we're really talking about giving you an understanding of management assertions and how important it is that you understand management assertions. We as auditors are testing the assertions. We're not necessarily testing the number. Now, some would argue with me and say, no, we're testing the number. Yes, we're testing the number, but we're also testing the assertions first. When we test the assertions, we're at the same time testing the number. It's kind of like, if you do this, then this will happen. If it sounds like a duck, it quacks like a duck, it eats like a duck, and it looks like a duck, it better be a duck. Okay? That's kind of what we're talking about here. Okay? If it exists, if it's complete, if it's accurate, and there's no claims, then we can say that that $2.6 million actually is in the bank of the company. Okay? So, in this lesson, we gave you a base foundation of assertions. In the next lesson, what we're going to do is we are going to give you all the assertions. So there are all of these assertions that we said. So you might say, well, how do we know that the assertion exists? I'm going to give you all the assertions in the next lesson, and then we're going to categorize them in the next lesson. So when we start to audit, we might say, okay, we're going to audit accounts receivable. Well, you have all these lists of assertions. Which one of these lists of assertions pertain to accounts receivable? Some assertions do not pertain to what we're trying to test. Okay, but some of them are. So next lesson, we're going to talk about the assertions, what the assertions actually are, and then the categories that we put them together with. Hey, thanks for watching my video. If you like what you saw, make sure you press the thumbs up button that's right below here. If you have any questions, make sure that you leave a comment or that question in the comment box below. And if you haven't subscribed yet, make sure you press the subscribe button. It's just below me. Hey, if you want more videos like this, make sure you go to www.patrickleemsa.com to see more videos like this, or if you just want to learn more about accounting. Thanks for watching. We'll see you in the next video.